So welcome everybody to the London Financial Regulations Seminar, our 6th for this academic year. And we're very, very happy to have Joel Suss join us from the Bank of England. And he will discuss his recent paper, co-authored paper on organizational culture and bank risk. It's an event co-organized with the Institute of Banking and Finance Law and Institute of Regulation and Ethics at Queen Mary. We'll basically have a presentation of about 40 minutes. And then Costanza Russo, who's our expert in ethics and governance at Queen Mary, will open the Q&A with questions. As always at these seminars, feel free to post questions in the chat if you, throughout the presentation, have any sort of clarification questions. Joel is more than happy to take any questions. And with further ado, I assume we would start the presentation. Up to you, Joel, and thanks very much for joining us today.
Great, thanks very much for having me. Really a pleasure to be here. I'll just share my screen. So sorry, you're seeing sort of, oh. Does everybody see that? Is that great? Okay, so yeah, thanks again for having me. Really delighted to present this piece of research, which we published as a Bank of England staff working paper in March. So the topic is organizational culture and bank risk. So I'm Joel Suss. I'm a research data scientist in the Advanced Analytics Division at the Bank of England, and alongside my colleague David Bholat, who's here as well, and two colleagues from the London School of Economics, Alex Gillespie and Tom Reeder. We've produced this piece of research. So Alex and Tom are organizational psychologists, so a lot of the work in this paper actually builds on their wider work in organizational culture. So I'll talk a bit about that as well. And just the usual disclaimer to start, which is that the views expressed here are my own and not necessarily those of the Bank of England or its committees. So just to make that clear. So what's a good starting point for this research? So my boss here, Andrew Bailey, the governor, in a speech back in 2016, he was also my boss, but he was the head of the PRA back then. He gave a speech on culture. Basically, he said, culture matters, but there's an issue in terms of measurement. So he made the case that culture is important, a major influence to the outcomes that matter to us as regulators. But as supervisors, as bank regulators, we can't go into a firm and say, show us your culture. So asking to have a bank show us or demonstrate their culture is not something that's going to achieve the desired answer as it would with asking about capital levels, asking about some verifiable bank variables. So there's a measurement problem at heart here, and that's what we're trying to tackle with this paper. So how does culture currently, or what's the sort of standard approach of measuring culture? So that's in the Bank of England, and academic research usually conducts surveys or makes use of survey data to assess culture. As supervisors, we also tend to interview bank executives, board directors, senior managers. So that kind of cultural information is basically asking, when we try to use those sorts of information, we're basically asking for a view of culture from employees. And we know from a lot of research in behavioral and psychological sciences that those sources of information tend to be unreliable. And so in the paper, we go through a few of these reasons why. I've got 4 bullet points here to explain the different ways in which those sources of information could be unreliable. So the first is something that is perhaps a bigger issue for regulators. It's the problem of impression management. When we ask certain executives or board directors to tell us about their firm's culture, or to tell us about the firm in general, we might get a sort of consciously managed type of response. So really, we try very hard to sort of see behind that kind of impression management, but it is something that could potentially throw us off. Now, secondly, and more unconscious, more sort of potentially pernicious, is this idea of normative context. So even if an employee was willing to be completely truthful about their firm's culture, or truthful about anything related to the firm, they might actually be so embedded within the culture that they don't really recognize what is abnormal versus normal. So they basically take on board the culture in such a way as for it to sort of feel normal, and that makes them unreliable for the purposes of explaining the kind of culture that the firm has. Thirdly, and this is something that's just a general point about surveys, they tend to be non-representative. So often surveys miss important parts of the organization, and so we might not get a clear picture of culture from looking at surveys. We might miss, for instance, people who have important critiques about the firm's culture, or people who tend to be senior are also those who tend not to respond to surveys as much as other employees. So that's a real problem for using that type of information. And lastly, talk about culture is not the same as culture. So what we get in terms of people's what they say about their culture is not really necessarily how they behave. And this is general disconnect sometimes, which is often remarked upon in behavioral science literature, about a disconnect between talk and action. And so this is really especially the case when it comes to culture. And lastly, I just want to make the point here that these methods, surveys, and interviews are particularly unreliable when they matter most, when, for instance, there's poor culture. So that's especially, all of these critiques are especially the case when an organization does indeed have poor culture. And so that's a real challenge for regulators, for academics to properly assess organizational culture. So what do we then, what's our solution to overcoming these limitations? So we're leveraging this conceptual framework by Alex and Tom, our co-authors on this paper, that they introduced in earlier work, which is to gather unobtrusive indicators of culture, or UIC for short. So a UIC is actually refers to a single measure based on data collected without engaging employees. So that's where the unobtrusive comes from. So it's not asking employees to show us their culture. It's watching or looking at the data which reveals aspects of the culture. So yeah, the second point here, it's also non-reactive. It reveals culture in action without sort of asking and without getting people to talk about culture. So a couple examples. So for instance, if gender diversity is important, we might, instead of just asking employees about how important diversity is to them, we might actually see how many women are on the board relative to men, or what kind of vocabulary, what kind of words are used in their documentation, and that might actually reveal aspects of the way that diversity is held within that organization. So one single UIC reveals potentially a bit about culture, but we don't expect actually one UIC, say the diversity on the board, to reveal the whole picture of a firm's inclusivity, the culture of inclusivity. Rather, it's through a battery, it's through a combination of many different UICs that we expect a picture to emerge. So that's the sort of aim of this paper, is to gather quite a bit of data, quite a number of individual UICs to sort of get pictures of individual organizations. So what are our research questions here? So the first one is sort of what I just said there. We want to harness data as best we can to measure culture unobtrusively. So in our specific case in the banking sector, as a regulatory body, we want to make use of untapped information which might reveal organizational culture in this unobtrusive way. And we think that this is useful because it might provide an objective and consistent assessment for all regulated banks. So rather than specific interviews by separate regulatory teams or supervisory teams, we have the same data speaking to all our firms, and so that is quite a potentially valuable exercise. And the second research question, and we spent quite a bit of the paper looking at this question, is evaluating whether culture does actually matter for the prudential outcomes that we care about. So, Andrew Bailey, the governor of the Bank of England, believes that culture matters. Personally, I started this research project also believing that, and a lot of people who are, thinking about bank culture also expect that to be the case. But this is actually not something that has been empirically examined before. So we're the first paper to actually examine this and test this hypothesis that poor bank culture leads to higher risk. Okay, so now I'll just talk about the data in more detail. So we gathered a total of 20 individual UX from 6 different sources. So each of these UX were selected because they conform to the organizational culture profile. This is a scheme to categorize cultures in terms of different distinct dimensions. So it's a body of research which dates back a few decades, and it's a good way of disaggregating culture into component dimensions. And also, that's for our purposes to sort of to give us rationales for choosing specific UX. So that scheme covers 7 different dimensions. We've only got data here, the 20 individual indicators, only cover 5 of those dimensions. So they're listed here. So customer orientation, detail orientation, inclusivity, integrity, and risk orientation. So I'll go through these in turn. So first, customer orientation. So this is just how well customers are treated, what kind of culture of customer centricity exists within a firm. We've got 5 different indicators here, all derived from the same source of information from the FCA. They have a specific report where they get banks to submit on a half-yearly basis the number of complaints and a number of different variables which have to do with customer complaints. So from there, we've taken these 5 indicators, and broadly they cover sort of 2 components. So first, there's how customers are treated by sort of the pure volume of complaints that are received. Gives an indication of how customers are treated, but also once customers do complain, how those complaints are treated. So we have things like the time that it takes the complaints to be closed. So whether it takes a slow amount of time, which we define as greater than 8 weeks, and also how much money is paid in redress. So the amount of money per closed complaint is another one of those indicators which tells us something about how complaints are treated once they're made. For detail orientation, and this has to do with the sort of analytical precision, how seriously banks take their analytical capabilities, how precise they are. And we have 5 indicators here as well. So as the Bank of England, we get firms reporting to us about their current financial position and a number of different balance sheet information. And we, from those regulatory returns, can get a sense of how good or poor quality they are. So we can raise a number of red flags depending on whether the numbers that are coming in make sense given previous numbers. So these are plausibility checks. We also can measure how late firms report or how early they report to us on the flip side. And then inclusivity. So this is about diversity and collaboration. We have 4 indicators that are derived from Form A's. These are application forms. So all senior positions are approved by PRA and FCA. So most of the members of the board will be approved by us to carry out those functions. And so from these application forms, we can gather information on gender and age. And so we have a number of metrics which relate to diversity of gender and age, as well as the sort of the differences in diversity between different parts of the authorized pool. So the difference between the oversight and executive body. And then for integrity, so this is one of the sort of key dimensions often spoken about when we talk about bank culture. So sort of an ethical dimension here. We've got 3 indicators here. So we are also we have a pretty at the PRA we have a whistleblowing function. So we encourage whistleblowers to come forward to us, and so from that we have the volume of those referrals that come into us per firm. We also have operational risk returns reported to us. So these are when specific forms of operational risk crystallize, they get reported to us. And one of those categories is around internal fraud. So the scale of internal fraud in terms of the number of events related to internal fraud, as well as the cost of that internal fraud. So we believe that relates to this ethical culture. And finally, so also an important dimension from for the banking sector is risk orientation or risk culture. So we have 3 indicators here as well. So these are derived from regulatory returns, again, from capital requirements information. So we basically define peer groups, firms which have similar sizes and business models, and then we get some relative variables here around the capital buffer and average risk weight. So we see the difference between a firm and its peer group in terms of the capital buffer and average risk weight. So to get a sense of their risk orientation, and also the ratio of Pillar 2 capital requirements to total capital requirements. So to get a sense of how what kind of risk culture the firms have. I can't see the chat box. So if there's any clarification questions, or if anybody has a quick question at this point on the data, then please do interrupt me.
I guess everything is clear so far. So
great. Okay. So yeah, thanks. I'll carry on with some descriptive statistics now. So we have 20 individual indicators. But really
Joel, we have one raised hand.
Oh yeah, sure.
In the chat. Nugisali, if I hopefully pronounce it correctly, please feel free to ask your question.
Yeah. Hello all, it's Nugisali. Thank you for the presentation. Just very quickly, I was wondering, you kind of rely on the bank's good faith to report some of these indicators, because whistleblowing complaints are not something that I believe banks will report very easily. So have you considered that, and how did you deal with it?
Yeah, thanks. That's a really good question. Of course, if a firm, if we see a lot of whistleblowing complaints come through from a specific firm, that just might mean that the employees there are sort of empowered to get in contact with us or the FCA more so than another firm. And a specific culture at a separate firm might actually be more restrictive or give a sense to their employees that it's more difficult to report. So that's possible. We can't really account for that. I mean, we would just sort of say that we actively encourage whistleblowing. People that do whistleblow to us are protected, and they're anonymous, and we don't ever reveal that information. The banks themselves wouldn't know who is providing these whistleblowing cases. Obviously they would, in some well-known cases, have tried to sort of uncover whistleblowers, but that's something that's really frowned upon. More frowned upon. It's really something that can get a bank into trouble, basically. So yeah, we just assume that the number of whistleblowing referrals that every firm, the employees of every firm feel as empowered to whistleblow as any other firm, and just take the volume as being representative of more problems in the firm that are being revealed to us. And similarly for other indicators, we can't really tell how much of it is not being reported to us, for instance, in operational risk, but we just have to assume that we're getting a clear picture.
Thank you.
Okay, so I'll carry on now with some of this descriptive statistics first and some trends next. So we have 20 indicators from a range of different sources. Really what is helpful for policymakers, for regulators, is to have a summary score. So to have a score of culture for every firm. We don't want to compare firms on 20 different indicators. We want to have a sort of summary measure. So we aggregate all our indicators. We do so in two ways. First, to the dimension. So to each of those 5 dimensions, we aggregate the specific indicators relating to that dimension, and then overall as a summary score. So first, well, the way we do this is by taking the simple average. So we take each indicator, we scale it so that it ranges from 0 to 1, preserving the distribution, thus making each indicator comparable, and then taking the average. And of course, to have that be appropriate, we have to kind of, as I say here, reverse the negatives, but just put every indicator in the same direction, so that we do so that 0 is bad and 1 is good. That obviously requires us to sort of have a sense of what good is for each of these indicators. And we think in the paper we make a case for each of those, and we think we have a pretty good rationale for each of those indicators. And yeah, so 0 is bad, 1 is good, with a simple average, and we allow for some missing indicators. So we think, because we have 20 indicators, it's just a pretty big number. We don't necessarily need to have all 20 indicators for every specific firm and quarter, but we can allow some of those to be missing and still have a number, the aggregate for that firm and quarter. So we allow up to a certain amount. If less than 50% are missing, we take the value as the average. So this figure on the right shows the correlations and bivariate distributions for each of these aggregates. And the reason I'm showing this is because if you look at the correlation coefficients for each of the dimensions, so the correlation between each of the dimensions, they're actually quite small for the most part. So a lot of them are very close to 0. There's some that are high, a bit above 0.1, but for the most part, they're very close to 0, and that just gives us comfort that indeed these different dimensions are actually getting at different, distinct components of culture, and we wouldn't want to see a correlation between them because we wouldn't expect a firm to be necessarily good in all. If you're good on one dimension, to be also good on the others, but actually you could be good in one dimension and not good in the other, and that's so that suggests that the different components are distinct. Then when we take the overall culture aggregate, this is actually pretty strongly, moderate to strongly correlated with each of the dimensions, which suggests that actually this aggregation, the simple aggregation taking the average of all of them, actually gives us a summary culture score, which does include all these different dimensions appropriately. So it's correlated with each of these dimensions. So it's just to say that it's an appropriate way of aggregating all the underlying information. Now let me show you some of the trends over time. So this is the average bank culture on a quarterly basis from the start of our period, which is we have data from 2014 to the end of 2020. This is the overall and the dimension scores, and what we see generally is basically no change. So the trend is pretty flat for each of these scores. Maybe you see the customer orientation score is maybe slightly higher towards the latter end of the period. But just as so this tells us that really the sort of average culture has not changed much, and that sort of chimes with other pieces of work, which also suggests that culture hasn't really changed too much over the recent years, and that also maybe suggests that culture is something that is hard to change, and that we have some anecdotal evidence of that. We can also use this data to sort of look at different types of banks and see, how culture compares across different types. So here we've decomposed, we've split out firms by whether they're a building society, whether they're a domestic bank, so headquartered in the UK, or whether they're headquartered outside the UK but have a subsidiary here. And so the building societies have generally a better culture. These are box plots, so the horizontal line in the middle of the box is the median value. So building societies have a different ownership structure, and they're owned by their customers, so we would expect them to have better cultures, and indeed they seem to have better cultures. But yet we still see this. Here's some outliers for the building societies, which are relatively poor in terms of culture. So it's not necessarily the case that you are a building society and you have this great kind of culture, but there is quite a lot of variation there. Now looking at this by dimension, so customer orientation seems to be a bit better for the building societies as expected, but international subs also seem to generally do okay. Again, there's this sort of long tail here, so within each category, there are banks that don't do so well on culture. Inclusivity also is the other one that stands out here. So building societies tend to be more inclusive, and international subs seem to be the performing the worst in that dimension. Integrity, based off of the metrics that we used, a lot of firms don't have much internal fraud, or at least not reported to us, or don't have whistleblower referrals. So that's why these are generally, for the median firm and for most of the distribution, are pretty good scores. But there are these long tails of you would say sort of lacking integrity, banks that lack integrity. So that's just a flavor of the descriptive analysis that we can do with this data. Obviously, internally at the Bank of England, for supervisors, we can look at specific banks. We can compare banks, individual banks, with one another. That data is pretty sensitive. We don't reveal that data, so we haven't published anything based on that kind of analysis. But that's something that is possible with this kind of data. So now I'll get to the second research question, which is about the relationship between culture and bank risk. But I'll just pause again for a moment just to see if there's any quick questions on that descriptive analysis and aggregation approach. Okay, I'll take that as okay to go on. Okay, so now we want to evaluate this. So how do we measure risk? So we've got a standard measure of risk called the Z-score. So this is based off of return on assets plus the leverage ratio divided by the volatility of returns. So this is the standard deviation of return on assets for the previous 8 quarters. So we take the standard deviation for sort of the recent past. And what this gives us is a sort of distance to default measure. So the higher the score, the further away from insolvency a bank is, and the closer to 0, the closer the bank is to insolvency. So that's our base measure of risk. And now what we do is basically we run a number of regressions, and I'm just showing you the coefficient estimates for the aggregate culture score from those regressions, and we do a number of different regressions to just see whether our results are robust or whether they're sensitive to different cuts of the data, different types of approaches. So here's just using the Z-score, and then for different cuts of the data. So the full sample is this triangle, and with the confidence uncertainty intervals here. So basically what this tells us is for a decrease in culture by 1 standard deviation, so one sort of average distance from the mean value, we would expect to see an increase in risk of around 25%. So this is actually because the confidence interval between 20 and sort of 35%. So that's quite a substantial increase in risk for a decrease in culture. That's the full sample. Then we cut this by size. So we've got large firms over 50 billion. We've got medium-sized firms between 1 and 50 billion total assets, and then even small firms, so less than $1 billion in total assets. And really, even regardless of this kind of the way we cut this sample, we see pretty consistent, sort of hovering around 20 to 30% as a central estimate for the relationship between culture and risk. So an increase in risk for a decrease in culture. So we check whether this is robust to different ways of measuring the aggregate culture score. So as I explained before, the main approach was to take a simple average, but we of all the indicators with some missing values allowed, we also look at just complete cases. So we don't allow there to be missing values. So every bank has to have a value for each of those 20 indicators for us to take a number. We also look at complete cases without internal fraud, and that's because we're missing a lot of data for internal fraud. Not every firm reports to us those very detailed operational risk returns. So we look at the complete cases, the full sample, and without internal fraud. We take the first principal component. So this is another common approach to aggregating a number of indicators into a summary score. So taking the first principal component, I won't go into the details about how that's calculated, but it's sort of common approach. Regardless of whether we do those things or whether we remove each dimension in turn. So we just want to make sure that our results aren't being driven by a specific dimension of culture. So we remove each one in turn. Regardless of how we come up with this aggregate culture score, we see a pretty consistent picture here. So these are the coefficient estimates, again, for a standard deviation decrease in culture. What's the expected increase in risk as measured by the Z-score? And so we, again, see, sort of central estimates are between 25 and 35%, roughly. And then, that's all with the Z-score. So we could also say, well, is our results driven by that specific measure of bank risk? So we evaluate different measures. So here's a number of different approaches. Because we can't translate it into the same percent increase or decrease, we actually just look at the standard deviation increase in culture score and how that affects the outcome measure in standard deviations. So we look at, for instance, non-performing loans, so a measure of asset quality over total capital, CET1 capital. We look at the PIF score. This is the subjective summary score that Bank of England supervisors put on firms. So they judge how risky they are through this PIF score. We look at the Sharpe ratio, which is similar to the Z-score, but using return on equity instead of assets. We also vary the window used to calculate the Z-score, looking at different lengths. And we also lag all our measures by 2 years for the Z-score and the Sharpe ratio. And regardless of the different which measure of risk that we take, we still see a fairly standard, a very consistent standardized coefficient here. So for a standard deviation increase in culture, we see an increase in risk as measured by the asset quality or PIF or the Z-score. So in either way, these are in reverse directions, in different directions. So, but they're all pointing to increased risk for a decrease in culture. So the same picture emerges. Okay, so I'm going to show you a regression table. I'll explain what this means just in words, and I won't go into detail here. Basically, we want to understand whether the relationships that I've just showed you are causal in nature, or whether they're, whether we can say something about the causal nature of those, whether culture does cause increased risk, or whether it's just a sort of correlation. So we do an instrumental variable regression, where basically we try to take the exogenous component of culture, and then that is for sure exogenous to other potential factors, and see whether that's also related to our risk score. So that's what this table shows. And another approach to sort of trying to increase the causal interpretation of our results, coarse and exact matching, we still find a similar finding here. Lastly, okay, this is the last thing I'll show you. And again, I'm sorry for the regression table. It's not that accessible, but we want to sort of try to understand what the mechanisms are behind this result. So the Z-score that I introduced earlier takes the return on assets, the leverage ratio, and divides it by the volatility of returns, the standard deviation of returns on asset. So we could just look at how culture relates to each of these three components separately to try to sort of tease apart the mechanism through which this is working. And so what we find is that culture is better cultures lead to better performance, as mentioned by the return on assets. So this positive number here, and better cultures see a reduction in volatility. So said the other way, poorer cultures have more volatile returns. For the leverage ratio, for the simple leverage ratio, there is no relationship. So it seems like culture is working through the performance channel, and this sort of the erratic nature of poor cultures have more erratic performance results. So I'll leave it there with this conclusion slide. So basically, we looked at two separate questions, and we measured culture quantitatively, covering the universe of regulated banks and building societies. And we spent a long time looking at whether culture is important for prudential outcomes, and we find this robust and substantive relationship with bank risk. We see this as only the start of a longer research project. So we've got 20 indicators, but we feel like there are many more out there which can be helpful for speaking to culture. As I said, we're missing a couple of dimensions from the organizational culture profile, so that's one avenue to explore. And although we have some tentative evidence about the mechanisms, there's really a lot more to be said about how culture does affect bank risk. And so this is where maybe more qualitative methods, ethnographic kind of approaches might help us understand better how culture does indeed affect risk. So thanks very much for your attention. And we have our paper published as a Bank of England staff working paper. So please, if you want any more details, you can go there. And also feel free to get in touch with myself. Happy to carry on the conversation outside of this as well. So thanks quite a lot for your attention. Thank you.
Thanks a lot, Joel, for super presentation and super paper. There's already a few questions that were posted in the chat, but I'll first give the stage to Costanza to ask the first question, and then we can open it to the public. Please, Costanza.
Thank you, Katrien. Can you hear me?
Loud and clear.
Okay, great. So I put my headphones on, because I always envy yours. So I'm like, okay, I have to have some headphones on as well. But I'm
a trendsetter, what can I say?
But technology tends to fail me, and then they barely work. Anyhow, so thank you, Joel, for this presentation and for making it actually so accessible. So before I'd warned him that most of us are a group of very promising lawyers, but we might struggle a little bit with numbers. And I'm a lawyer with a PhD in economics, and I still do struggle with numbers. That's why I'm very sympathetic. So thank you for making it so accessible. I don't want to take too much time to the to questions from other members of the audience, but I do have a couple of them. One, it's similar to a question that Alan Brenner has asked already in the chat. So and relates to similar studies. So we all welcome, especially nowadays, we all welcome anything that is not intrusive. So I'm a great fan of your methodology, but I wonder whether you had the chance to look at those studies that instead included employees' responses and consultation to employees. And yes, one of these, the one that usually comes to mind is the one of the previously banking standard boards, now financial services board. Anyhow, but I appreciate that that might be private, but I'm pretty sure the results of those might be private, but I'm pretty sure that you might have seen literature. And so I wondered how your results compare to those other studies. And then my second question to you, and also, I don't know if David wants to chip in the audience, we also have David Bholat, who is one of the co-authors of the papers, who is a bit shy, but David, if you want to chip in, please feel free. So my question is, I understand what Andrew Bailey is saying, and I kind of have to agree with him by default, because he also wrote the foreword to the book that myself, Rosa Last, and William Blair wrote. So we are very well aware of his view. But as you know, one problem with ethics in general and culture is that this is something that is difficult somehow to supervise. I mean, the Dutch central bank tries to do it and does it successfully for all sorts of reasons. But normally, because ethics and culture are seen as something soft, people think that it cannot be supervised. So especially in light of the results of your second research question that shows the importance with relation to prudential risk, I wonder whether you think that your paper can pave the way for supervisors to be able to supervise culture alongside conduct in banking. And I'll leave you with these big question marks.
Well, thanks to really fantastic questions. So first on the BSB or generally on surveys and how our results come. So yeah, we don't have the BSB surveys to compare with, and we don't have sort of, besides that survey, like the same survey carried out in all our firms. So we can't actually do that analysis. But it would be great. It would be great to get our hands on that kind of data and also see whether there's a similar finding. I mean, given the sort of critiques I had at the beginning about surveys, we wouldn't necessarily expect there to be similar results. Specifically for firms which have poor cultures, we would, our research and research which we cite suggests that maybe we would be particularly missing those cases in survey data. Or we wouldn't be getting that kind of picture emerging from survey data. That said, I think the PSB, or I guess what's the new name, the FS,
Financial Services Standards Board, if I get
right,
this right, because they've opened their membership to financial services firms.
Yeah, so I mean, their survey is really to be it's very impressive. They have a very extensive survey covering trying to be representative, and I think that's what you need to do if you're going to do a survey and be comparable across firms. So they're covering different sort of positions and different divisions within banks. I think that's really great. So I would love to see what how the results match up to ours. I do know that some findings that they've shared publicly show that also culture hasn't really changed overall over time since they started. So I think that sort of chimes with what we're finding in terms of general trends. And then in terms of your last question, so yeah, I think I would definitely, you would expect me, given this research, that to argue for the ability to measure things like ethics and culture, obviously using quantitative data. I think we do demonstrate that. I think it's things like instances of internal fraud, whistleblowing do directly speak to cultures, ethical cultures, and so I think we can do that. I think there's a lot more to be done. Obviously, I don't think we have sufficient data to really capture perfectly sort of whether a bank is ethical. I think we're starting that, and I think there's a lot more that we should that we can do and hope to do in the future.
Thank you. Thank you also to remember that this is very qualitative at the end of the day. It's, yeah. Anyhow, shall I read one of the questions in the chat? So the first question by Alan has been answered already, I would say. Then we have, again, another question from Alan Brenner, who is asking whether you managed to backtest a methodology against problem banks in the recent past, for example, COP, HBOS, etc.
Yeah, thanks. That's a good question. So our data starts in 2014. So it's a limit to what we that kind of exercise given that start time. But yeah, the data does allow us to look at individual banks and to do that kind of analysis. So I'll just sort of leave it there. I won't talk about specific cases.
Thank you, Joel. Then we have another question from Andomaki Gergosauli, who is a senior lecturer with us, who is congratulating on the insightful presentation. And the question is there any mechanism to safeguard the objectivity of the measurement from the risk of bias? For example, any embedded biases of those who interpret the data to draw conclusions about culture? Yeah, bias is a big issue.
Yeah, I think that's really interesting. I mean, I guess the first thing that came to mind there is, given our method of aggregation, as I sort of explained, we have to have a sort of theoretical, we have to have a position on what's good and what's bad for each of these indicators. I think that, introduces, we have sort of prior hypotheses on each of those indicators. And so that could be a source of bias. Other methods of aggregation, like taking the first principal component, actually, doesn't we could overcome that using that approach. So that might be something to consider. But I wonder if you had any other ideas of sources of bias. I'd definitely be interested to hear, potential what you think about that.
Shall I leave this question to Andomaki then? Andomaki, are you with us?
Hello there. Yes, I am. Thank you very much. I'm not using the camera because I have a terrible internet connection this evening. I hope that's okay and that you can all hear me.
Yes.
I was also thinking about embedded biases in the analytical model that they are using. So it can be biases in relation to those who sit down and try to make sense of the data, but also biases of those who are developing the model. They make some assumptions. There are possibly other sources of bias. Right now, I can't think of any, but I would welcome the opportunity for a further discussion subject to the availability of our excellent speaker this afternoon. Thank you.
Thanks. Yeah, of course, I'm very happy to carry on the conversation. I think you're totally right to point that out. Yeah, we try to, sort of look at whether our results are sensitive to a number of different choices, to overcome that potential issue. But yeah, let's carry on this. Please do get in touch.
Thank you very much.
Yeah, I think some parallels can be drawn here also with the employee surveys. I think you might get similar type of biases there. Anyhow, any other questions? Or if Alan wanted to comment any further. So, so Charles Goodard is asking about reverse causation.
Yeah, thanks, Charles. That's an important question, and I didn't sort of make that clear in my presentation. We lag all our variables in the base case, in the base models, by 1 quarter, and then in robustness checks by 8 quarters, so by 2 years, just to sort of mitigate concerns that bad firms or risky firms are causing poor cultures, and so the relationships the other way. And then we also look at this instrumental variable regression to try to sort of which has those 2 year lags to try to overcome that concern. But yeah, it's an important concern. So we just do the best we can to deal with that.
Thank you, Joel. There is another question from Ben Norman, who it seems to be challenging himself as well. So he's saying, as a former supervisor, my instinct in practice would be to use quantitative measures of culture as a relative rather than an absolute concept. For example, if the measures are showing a deterioration of culture at the firms I'm supervising, I would use that to challenge the firm's executive. Do you feel I'm not being too ambitious?
Hi, Ben. Good to hear from you. I know Ben, and so that's a good question, and thanks for that. So yeah, I think you're right. It is a relative concept, and you know we basically that's what our measure is the 0-1. We've sort of rescaled all our indicators to sort of just give us a sort of similar range across them, and then take the average. So it's sort of the absolute number in itself doesn't really tell us much besides the sort of rank. If you're 1, you're the best. If you're 0, you're the worst. And everywhere in between, I think it's right to sort of look at peer comparisons. I think that's the sort of the right way of thinking about it. But I would say actually the peer comparison is important, but obviously there still is some meaning to the absolute number, so we shouldn't sort of completely discount it. Yeah. So I hope does that address your question totally?
So Ben, do you feel you still have not been ambitious enough?
My answer might not have been ambitious enough. So yeah.
Yes, please, Ben. Yes, please. He's asking if he can speak. But if you are speaking, you might probably be on mute because we can't hear you. Ben, you are on mute indeed. We can see, okay, there you are. We can see you.
Hi, sorry, I think my internet cut, but I am back now. Sorry about that. I'm not sure what I missed. Maybe Ben had chimed in.
He did. I could not hear him, but I don't know if it was only me.
Oh, okay.
Let's ask Katrien maybe.
I couldn't hear.
Oh, you could not hear Ben either. Okay, Ben, we have had some problems with your microphone. We could see you unmuted yourself.
Happy Ben we could catch up later. It might be.
Yeah, or we can continue writing in the chat. But meanwhile, Alan, I can see has his hand raised. So Alan, do you want to ask a question?
Yes, it's really just going back to the methodology. I was wondering, Joel, you're using 95% confidence levels. Is that good enough? Should it be much higher? Because it depends on what sort of risk you're looking at. That some of the risk actually might be in the tail.
Thanks. Yeah, that's a good question. I mean, what's the appropriate confidence threshold? There is a big movement now to go below 5%, or certainly not use 10% as a sort of legitimate threshold. Yeah, we use 5% as the sort of as the sort of default. But you're right. I think if you look at the paper, we have all the sort of stars there. I think most of them are below the 1% threshold. So I think we'd be sort of confident from that level as well. I think in general, I would just say the sort of pattern of the consistent pattern of the sort of the size of the coefficients, and some of them I think actually you're right might not be significant if you use the 1% threshold, but I think, in general they would be, and the size of the coefficient is fairly consistent. So I think that sort of lends credence to the, that there is this relationship there, and we are sort of picking up this actual relationship that exists. Yeah.
Yes, a lot of it depends on what sort of risk you're looking for. If it's to do with capital, liquidity, those ones, yes, that's definite. If it's something more subtle, then may not.
Yeah, that's a good point, and that's why we look at different risk outcome measures. So we look at, the Z-score could be thought of as, this sort of hybrid between performance and capital.
Yeah.
We look at sort of asset quality. We look at return on equity. So there's also sort of covers those two components, and then the PIF score, which is completely different. And so we try to gain confidence by looking at these range of different outcome measures. But yeah, in principle, we haven't sort of covered all the possible sort of manifestations of risk. So yeah, that's a good point.
Good. No, thank you.
Thank you both. Okay, so we have a very final question, or well, the follow-up from Ben, who cannot come off mute. So basically, its only follow-up was to ask whether Joel's answer was about peer comparison, and mine was about comparisons of the same firm over time. With peer comparisons, I don't see that firms X culture ranked N and firms Y's culture ranked N+1 tells me much. But comparing firms X culture score at T and then at T+1 tells me something about whether the firm's culture is improving, deteriorating, and that really gives me something to get stuck into when I'm supervising the firm. But am I missing something by focusing on time series rather than cross-sectional analysis?
I think they're both important. I would actually just caution though for the time series dimension, because we know culture changes slowly, and although we might see these fluctuations over time for a given firm, we shouldn't sort of these are potentially just noisy kind of fluctuations in the underlying indicators, which might not our feeling is that because culture changes slowly, it's better to collapse the time dimension, at least in part, to get a sense of for specific firm, because we want to if we see a trend over time that pretty consistent over time, then maybe that would give us an indication of where the firm is headed. But I think in short periods, I would caution against that.
Okay, thanks from me, and thanks from Ben, and also from me. For 2 seconds, I felt I was again in my econometrics classes. I was like, whoa, down memory lane. Anyhow, I'm a bit conscious about time. Katrien, this was scheduled to finish at 6, right?
Yes.
Okay, so Joel, thank you so much for such an insightful presentation. Thanks to all the attendants and all the participants. We hope you enjoyed it. And I mean, if we all were in person, I would, well, actually we can clap with reactions. So I would please ask you to join me thanking Joel in this new normal. And please be in touch with him. So, okay.
Zoom intervention. So
Zoom intervention. Okay, anyhow, thank you so much everyone for being here, and I will have to bring this to a close.
Thanks very much for having me. Thanks, a really great discussion. So
thanks very much,
everybody.
Joel.
Thanks, Joel. We will have a follow-up one.
Great.
When you come down to London to enjoy
yeah,
the pub fantastic. Opening and the sun.
Thanks, that'd be great.
Okay.
Bye, everyone.
Thank you.
Bye.
Thank you, everybody. Bye, David. Bye, everyone.